financially speaking, when you're looking at the numbers, and numbers ultimately don't lie, is you want to make interest-only payments on your non-deductible debt and put all of your surplus cash flow into deductible. But I just have such a strong aversion to paying interest-only payments on a loan that is as significant as what it is. And so I think, personal opinion, irrespective of, how it works out financially, if you can't afford to make, and this is a harsh statement, but if you can't afford to make principal and interest repayments on all of your loans, then you shouldn't have them.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back on the 360 Money Matters podcast.
Andrew, we are back again and we say it week in, week out, but it's our favourite time of the week.
I just realised, and this is going to completely throw us off, 360 Money Matters. Say that 10 times super quickly. There you go. You got yourself a tongue twister.
I might need a few more coffees before I can say that.
Before, at risk of completely throwing us off track, what are we talking about today, Bills?
Andrew, this one is really juicy and I'm really excited about this because I don't know if it has. It's been a question that we've been getting a lot of.
I think probably because we've spoken and touched on it a few times, but haven't done an episode for probably a year and a half about it.
100%. And that's what we're going to get to. But I'm trying to build this up here. But the question that we keep getting asked is, should we put more money into our mortgage or should we put more money into investing and say superannuation? And this here, our response is kind of like, why don't you do both? I'm thinking of the Stand and Stuff commercial with the tacos.
Well, the Mexican girl.
Yeah. So we're talking about debt recycling again, which is essentially doing both. So we'll do the deep dive, the good, bad, the ugly, everything associated with it.
Yep.
And give some ideas and some thoughts to our viewers and our listeners as to whether or not that could be a strategy that could be worthwhile for them.
Yeah, we love debt recycling at 360. I mean, this is a strategy that we use, very frequently, and it can just be such a powerful strategy. And it's something that just kind of hasn't really made it into mainstream. I mean, you think about, purchasing investment properties, you think about, putting money into super, like everyone's kind of heard about it, but you talk debt recycling, and even when you're talking to, other professionals in other industries, a lot of the times they haven't even heard about it. Without further ado, what's debt recycling, Billy?
Thought you'd throw that one off to me, huh?
Exactly right.
So this is where we need a whiteboard, but I'm going to try and do this without the whiteboard and keeping in mind that we're talking to people that are going to be listening to this as well, as opposed to looking at us. So my hands are going to be going all over the place, but so
it's all right. We're Greek. We like to talk with our hands anyway.
So essentially, if you think about, I guess, what is referred to as good and bad debt, that's probably a really good place to start. So if you think about your mortgage being your owner-occupier debt, the reason why it's called bad debt is because that debt is not tax deductible. As opposed to when you think of investment debt is tax deductible, it's referred to as good debt. Yeah. So and on that investment debt, I guess there's probably one main thing that we think about is being an investment property and the loan that you've got attributed to that and the interest that you pay on that. The second one is potentially if you take out a facility to buy income producing assets like, say, a share portfolio. So the theory behind this is that at a particular point in time, going back to that question saying, do we drive down our owner-occupier non-deductible debt, pay that off and then consider investing, or do we do something else? So a debt recycling strategy is where, and I'll use a really simplistic example where you've got some equity in your home. Yep. You might take out some equity for investment purposes. Let's just say for round numbers, you've got a $500,000 home loan. You take out $100,000 of equity. The $500,000 is non-deductible debt, so that continues as normal. The $100,000 is for investment purposes. You do it as a separate split, and you take that 100,000, you invest it into income producing assets. So in this case, we'll talk about a share portfolio just to keep it simple. The $100,000 now becomes tax deductible. The income that gets generated from the share portfolio goes into reducing your home loan, your non-deductible debt.
Yep.
And then over time, as your home loan goes down with the additional income that you're getting from the investments, you then borrow that same amount back out of the loan to then top up your investment to create even more income. And essentially, if you can picture what happens, and it's hard to do without a diagram, but your home loan non-deductible debt goes down while your deductible investment debt goes up. And over time, what happens is you're accelerating your non-deductible debt down faster. You're increasing your deductible debt. So essentially, as the name suggests, is you're recycling your debt from non-deductible to deductible.
And it still sits against your owner-occupied mortgage. You haven't needed to do anything with your mortgage other than just have a loan split, essentially, that sits against it.
Yeah, I mean, in this instance, I was just talking about using a home loan as a product. There are other products and stuff out there, but conceptually, that's probably the easiest way to try and explain it without having a whiteboard.
Yeah, yeah. To maybe add some complexity to it without a whiteboard, because this isn't challenging enough, I'm going to use some numbers, and I'll use a scenario, right? Because I think it's a little bit easier to sort of explain it when you're talking about numbers.
Yeah.
So let's say you've got a $500,000 mortgage, right? Forget about what the property value is. Let's use this scenario. Well, let's just use the scenario of you've actually got a parcel of shares that you contributed to, right? And you've got maybe 100 grand in some shares. What you're doing with this scenario, or how you might utilize a debt recycling strategy, is you take that $100,000 parcel of shares and you sell it. So sell all of the assets and use $100,000 to pay down your $500,000 loan. So your $500,000 loan goes to $400,000. Now, the assumption in all of this is that you haven't made a huge capital gain or anything like that.
Transaction costs,
all of that stuff. So you need to factor that in. But now your loan's sitting at $400,000 and you don't have any shares. Yep. You take $100,000 equity out of your loan. So your loan goes back up to $500,000 and you basically have a split. So your loan position's the same. You still got a $500,000 loan. You use that $100,000 that you took out in equity that's now still sitting against your owner-occupied mortgage, but is just in a separate loan account, and you use that $100,000 to invest in potentially even just the same shares. So your position is still the same. So now you've still got $100,000 in shares. You've still got a $500,000 mortgage. The difference is in your mortgage, you've got a $400,000 mortgage that is non-deductible, and you have a $100,000 mortgage that was used for investment purposes. And because it was used for investment purposes to buy shares, it is now tax deductible. Mm-hmm. So all of a sudden, you've converted $100,000 of your mortgage from non-deductible to deductible. Then what Billy was referring to is, as that $100,000 parcel of shares starts deriving income, you don't actually reinvest it back into shares. You draw the income out of the portfolio. You use that income to pay down your $400,000 non-deductible mortgage. So you still keep the $100,000 exactly as is. Any amount of money that you're paying down your non-deductible mortgage, you actually draw out in equity out of your deductible mortgage and top up, putting additional money into your investment. And so in essence, your non-deductible mortgage is slowly shrinking, and your deductible mortgage is slowly increasing, but your debt position, so the bands on either side, are still staying exactly the same.
So in this instance, your debt position would stay at $500,000.
Exactly right. Yep. You want to put this on steroids, and you say, okay, maybe your savings capacity is, I don't know, $15,000 a year. That's how much you're putting towards your investments on an annual basis. Instead of taking $15,000 a year from your cash flow, to put into investments, you take $15,000 a year out of your cash flow to pay down your non-deductible mortgage. Then you take $15,000 a year out of equity, out of your investment mortgage to pay into the investments. And so over time, you now have the benefits of both worlds. You pay down your non-deductible debt, you still invest, and your deductible debt becomes tax deductible. And bada bing, bada boom, you've got a debt recycling strategy.
Clear as mud.
Exactly right.
Your scenario is easier to, or your explanation is easier to understand, because the critical thing here is that in most instances, we can do it differently, but in most instances, the debt level stays the same.
Correct.
So if you embark on one of these strategies, I think one of the things, and it's a good it's a good segue to talk about who this is relevant and beneficial for. But I think one of the key things with this strategy is you need to be comfortable looking at your debt position and going, it hasn't moved. Like the total debt, obviously the percentages have shifted between non-deductible and deductible, but you need to be comfortable enough to look at it and say, hey, in this instance, my debt was $500,000. I'm doing this, but my debt hasn't gone anywhere.
Yeah.
But the internal, I guess, the split that you've got between your home loan, your non-deductible debt versus your investment debt, your deductible debt has obviously shifted and recycled from sort of one bucket to the next.
Yeah.
So if you don't feel comfortable with keeping the debt keeping the debt level the same, I'd say that that's an issue, and that probably scrubs you out, at least in the first instance, of a debt recycling strategy.
Yeah, absolutely. Absolutely.
Andrew, what else should we be thinking?
I think some of the other considerations are, now, this is where it does sometimes become a balancing act between your comfort levels and your best financial position. So I'll use, I won't use necessarily a specific example, but we've got many clients that come into us, they're potentially young, probably have their first home, have a mortgage, and they want to get started on investing. So you're talking, lower sums of money to get started on investing. And that's great. Huge advocate for that. Now, financially speaking, the best thing that you can do is not actually take money out of your cash flow in order to be able to invest. So don't take money out of your offset to invest. Take it out of equity. Do a debt recycling strategy. But, some of the time, and potentially even a lot of the time, the strategy is not to take equity out of your mortgage. It's just to take it out of your cash flow. So don't embark on a debt recycling strategy right away, because the comfort levels associated with taking equity to invest mentally is a much higher barrier than saying, okay, I'm saving, $5,000 a month. Let's take 3 of it and put it into investments. So even though it may be financially the best thing to do, sometimes it's easier, it's less complex, there aren't as many things to understand, particularly when you're getting started out on investing and you're trying to grasp the concept of investing, let alone using debt to invest and all of the complexity associated with that. It may sometimes be just take the first step, just start investing, give yourself the option to, okay, at a future point in time, when the portfolio gets to X amount, you can sell a portion of it or all of it, use that to embark on a debt recycling strategy and onwards and upwards from there. So for us, a pretty big criteria before you're using debt to invest or a debt recycling strategy is you probably need to have invested before. You need to be comfortable with investing and then start embarking on something that's a little bit more complex and a little bit more of, taking the next step in a debt recycling strategy. Yeah,
no, well said, Andrew. And I think just to add to that, if you think about investment markets and, obviously the markets are volatile and you need to have a level of comfort associated with that, hence the reason why being an investor beforehand probably makes sense. But I'll take it a little bit further, because I tend to think about, if you think about market volatility by itself, it can be quite scary. Yep. But one of the things that we talk about, just from a general financial advice perspective, but that's also relevant here, is if you've got the rest of your financial life sorted, it makes that investment market volatility easier to handle, and you feel a deeper sense of comfort. So what I mean by that is some of the things that we look at in relation to deploying a debt recycling strategy is how secure is somebody's income? So have they been with their employer, they're earning the same amount of money, the business that they work for is stable, so there's no real risk associated to that. That kind of ticks that mental checklist box, as opposed to, if you've got somebody who's in a transient workforce or, things aren't looking too good from a workplace perspective because their industry is under pressure, I'd say tread with a little bit of caution.
Yep.
Probably the next thing above and beyond that is looking at their banking strategy to make sure that they've got a consistent banking strategy that they're deploying to make sure that they're trapping the surplus that they've got and that the surplus that they're saving each and every month is consistent. So you know that they've got a good handle around money management. And then probably the last thing I think is also critical is having your emergency fund. So have you got access to a pool of money just in case something goes wrong where, you don't have to fall under pressure and scramble to figure out, hey, what am I going to do? The hot water blew up, emergency dental work, something's gone wrong with my car, whatever it may be. Yeah. I think if you've got those things in place, that starts to tick off this mental checklist that we go through saying, yes, that person is more suited towards a debt recycling strategy. Andrew, what about income levels? I mean, we predominantly see this for higher income earners. Let's just talk through that as well.
Yeah, well, the higher the income that you are, the more beneficial that the strategy is. So when you're paying a higher income tax rate, if you're converting your debt from non-deductible to deductible, now this is never going to happen because most of the time, especially if you're a client of 360, you're retiring with no debt. But if you're retired, you've got all of your money into super and you've deployed a debt recycling strategy and you're left with this deductible debt, it's of no benefit to you because you're claiming a tax deduction when you've got zero tax that you're paying, so there's no benefit of the tax deduction. Yeah. Same on the flip side is if you're deploying a debt recycling strategy and you're converting your debt from deductible to non-deductible, as you're on, higher marginal tax rates, the more of a tax deduction that you're claiming, so the better off that the strategy ultimately is. So higher income earners are generally a better use case for a debt recycling strategy. But that's not to say, even if you're on a 30 or 32% tax bracket, still hugely beneficial to be able to claim a 30% deduction on an owner-occupied mortgage.
Yep. From a practical element, just going back to the structure of the loan, just in case we weren't clear around that, but what we tend to say is with the owner-occupier non-deductible debt that you've got, you generally keep that on principal and interest. So we're big advocates of principal and interest loans anyway, but keeping that on the same sort of pathway that you're already on ordinarily, repaying that principal and interest, keep doing that. The split that you've got, the investment loan that you're using for the debt recycling strategy, put that on interest only. And the reason why we say put that on interest only is because any principal reduction that you make, even if it's $1, you want that going to your non-deductible debt rather than your deductible debt.
Yeah.
Because you want to keep your deductible debt as high as you possibly can to maximize your deductibility while paying off as much as you can and as fast as you can your non-deductible debt.
I'm going to take us in a completely different direction.
Let's do it.
I'm throwing us off. So Bills, 100% when you're doing a debt recycling strategy makes sense. Opinion piece here.
Ooh.
You've got an investment property and you've got an owner-occupied property.
Yes.
Do you put your investment property interest only and your owner-occupied property principal and interest? What's your thinking around that? I'm throwing you on the spot here. This is completely
generally speaking.
Yeah, generally speaking.
Mathematically, yes. Psychologically, no. So let me explain. Similar to what I was talking about before, where you want all of your principal reduction repayments going towards your owner-occupier, your non-deductible debt. The same theory applies with an investment property per se. So service the interest and all of the additional principal goes onto your home loan. Mathematically, that's the right way to do it. Psychologically, and this is just a personal opinion, I've always had an issue with interest-only loans because I don't think, we're pretty fortunate in Australia that we can borrow money and not pay it back. Service the interest.
Fine.
You can refinance and re-roll it and bits and pieces, but I've always had an issue with that. So from my perspective, psychologically, I feel more comfortable if I've got debt, regardless of whether it's deductible or not deductible. I like the idea of paying that off with principal reductions as well too. In saying that, if maybe if I wasn't earning as much money or I wasn't comfortable in terms of my money management and I needed to do that in order to just make ends meet, I would do it the original way that you were talking about. But my own personal opinion is principal and interest for both of them, but that's just personal opinion. What about you?
I'm the same, which is why I asked the question. I had a fairly strong suspicion that we'd probably both be aligned in this, but potentially create an argument at the end of the podcast. But no, look, I agree that financially speaking, when you're looking at the numbers, and numbers ultimately don't lie, is you want to make interest-only payments on your non-deductible debt and put all of your surplus cash flow into deductible. But I just have such a strong aversion to paying interest-only payments on a loan that is as significant as what it is. And so I think, personal opinion, irrespective of how it works out financially, if you can't afford to make, and this is a harsh statement, but if you can't afford to make principal and interest repayments on all of your loans, then you shouldn't have them. And so, I'm also on the fence of, even though it doesn't make sense financially speaking, principal repayments or principal and interest repayments on all of your loans and surplus cash flow onto your owner-occupied loan.
Yeah. And look, I think that's a really good segue into thinking about the risks associated with this, because just thinking through as you were talking then, and I'm not surprised that we came out with the same answer, because financial advice, we tend to be prudent, I guess is the word. I wouldn't use the word conservative, but we tend to be prudent by nature. So I think from a risk mitigation perspective, it makes sense that you're paying down principal and interest in that regard. But let's push that aside for a sec. Andrew, what are some of the risks that we should be thinking about when we're going into a debt recycling strategy?
Well, the risks associated with it are primarily in that your debt position is not decreasing as quickly as it otherwise could have. And so when you're using debt, or when you've got debt, and essentially it's been used for the purposes of investing, it's going to magnify your gains, but it's also going to magnify losses. And so you need to be comfortable with, okay, I'm using debt to invest. It has to be a long-term strategy, because if it's a short-term thing, then absolutely shouldn't be the way that you go. So make sure that you've got an exit position covered. So how are you eventually going to pay off all of the debt? So you transition it to non-deductible, but you want to make sure that after it's made non-deductible that you're still then fully repaying it. And you also want to make sure that you've got, security of income, as you said, but then things like income protection policies. If something happens that's completely outside of your control and you're sick, injured, can't work, make sure that you've got a risk mitigation strategy, because again, debt payments will still continue even if your income doesn't come in. And so you still need to be able to have something in place to be able to mitigate that risk.
Yeah. Probably the only thing that I'd add as well too is just from a risk tolerance perspective. I mean, you are investing in income producing assets. They need to generate a certain rate of return in order for the strategy to be viable. It gets easier when interest rates are lower in that regard. Yeah. So exposing exposing money to investments and assuming investment risk, market risk, is just part and parcel of it. So I think from a risk perspective, it's important to consider that markets are volatile and they do go up, they do go down. Yeah. So making sure that you're comfortable enough with that. And once again, we've said it a whole heap of times on the podcast. It's a bit of a famous saying in the business that we've got. But if you can't pass the sleep test, if this keeps you up at night and you worry about it, then it's the wrong strategy to do. But I think it's important just to highlight that, because essentially, not that this is set and forget, because it's definitely not the case. Definitely recommend that you need to be under advice with an advisor in order to be able to do this. But if you're looking at it every day, if it's keeping you up at night, if you're worried about it, this is the wrong strategy. You need to be comfortable with debt. You need to be comfortable with the market movements as well too.
And you've got to have a good team around you. I mean, realistically, to get a debt recycling strategy just up and running, but also the management of it, when you're going through it, you probably need, a financial advisor to give you the advice and set up the structure of it. You need a mortgage broker to be able to implement the debt side of things. And you also need an accountant to be able to implement the tax side of things off the back end of it. So you've got to make sure that you have a solid team around you that you can trust, that understand how this strategy works in order to be able to execute as well.
Exit strategy. So let's run the scenario that we've gone through the debt recycling strategy. We have changed the deductibility to the non-deductible debt. So we've paid off our home loan completely.
Yep.
Let's use the example of $500,000, and we've then gone and increased our investment deductible debt to $500,000. So we've got no home loan. We've still got a loan in that example, but none of it is attributed to the non-deductibility owner-occupier. What do we then do from an exit strategy perspective? What are some of the choices?
Yeah, look, it ultimately depends on your strategy. Depends on what you want to do, depends on what your retirement plan is, depends on, all of the other things that sit around it. But there's ultimately a few, strategies that you can deploy then after. Yeah. One is, okay, you've essentially converted your home loan to deductible. So you've gotten all the tax deductions along the way, and it's, okay, now let's start putting extra payments on our non-deductible debt to bring that down, because you eventually want to be able to pay off debt.
So that would be using your cash flow like you were making your contracted repayments on your mortgage,
yep.
and using the income from the investment
to pay down your deductible debt. Yep. The other option is sell down a portion of the portfolio in order to be able to just fully expunge the loan and have a portfolio sitting at the end of that. Probably not the most opportune thing, because the whole purpose of a debt recycling strategy is to create a tax deduction. But it, again, depends on your retirement or your retirement goals. And the other thing is potentially you look at, okay, well, we've now created a tax deduction. That's great. That'll sit alongside our investment account, give us a tax deduction while we're generating additional income through the passive income. Okay, do we look at, let's add some other assets into it. Let's add an investment property. Let's add, any number of other assets into the portfolio. If you've still got that time frame to investment, if you've still got surplus cash flow, if you're still on that wealth accumulation journey. So this is, not your be all and end all strategy. This is just another thing to be able to add into, growing and expanding your wealth.
Yeah. And what I really love about this as well too, obviously the fact that we all want to get our mortgage out of the way as quickly as we possibly can. But if you think about what it looks like towards the end, then you have that choice. But what I really love is if you deployed one strategy over the other one, being just pay down your home loan, at the end of this, you get your home loan paid off, but you've also got obviously the tax deductibility that comes along the way, but you've also got another asset that you've used that's generated growth, assuming, at the end of all of this as well too. So it's not just, hey, I've paid off my home loan. Now I need to start thinking about what else do I do? You've actually got this as well too. And then you can make a decision. Do I continue using my cash flow to pay down the debt, plus the income that's coming off it to pay down the debt? Or do I take a lump sum, or do I do a combination of both? Or do I look at something completely different?
Yeah, exactly right. It's just giving you more options. Yep. That's ultimately what it is. And the more investments you have, the more things that you've got in your underlying portfolio and in your, wealth strategy, the more options that you have at a future point in time. Yeah. And that's the same thing with, setting an investment account just with contributions, out of your own cash flow without a debt recycling strategy. It's giving you the option to potentially explore debt recycling strategy in the future. It's giving you the option to potentially sell and use a deposit on a property, or any other number of options in your ultimate wealth accumulation strategy.
Yeah. I like it. Probably just in closing, Andrew, I said it before, but getting advice with this strategy, it's
necessary. Like, I wouldn't even say it's, strongly recommended.
I was going to say you can't do it yourself. You'd stuff it up. You'd make a mistake somewhere. So I'd say definitely get advice. Definitely get advice, because it's too easy to make a mistake, and the risks are too great if you don't do it properly. And not only just the setup as well too, but ongoing as well. If you don't know what you're doing moving forward, you can run into trouble and run aground. So yeah, definitely reach out and get some advice.
Absolutely. Yeah. Bills, love that. One of our favorite topics. So it's no surprise that we've ran longer than we normally do on the podcast, but
just value bombs left, right, and center.
Yeah, I love a debt recycling strategy. It's awesome.
Now, to our listeners and our viewers, look, thank you for today. If you've got any questions or want to explore this further, please feel free to reach out to Andrew or I. Details, as always, are in the show notes. Like and subscribe, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.